Hi, everyone. Welcome to Conway Conversations. I'm Carol Bulman, CEO of Jack Conway, and I will be your host. We have a really awesome plan for you today. We're going to be talking about unique financing opportunities. And the concept behind this is we're going to be talking about those little gems that you may not think of that could really make or break a transaction, either for a customer or for yourselves. I want to welcome everybody that has tuned in today. We really appreciate you joining us. We have a combination of Conway agents, we have buyers and sellers, and we have agents from other companies. And we really appreciate you joining us at Conway Conversations to talk about something that we think is important, and that is helping our buyers and our sellers uncover all sorts of opportunities to get into a home. So before I give you a little bit more of an introduction about what we're going to talk about, I'm going to introduce our amazing speakers. So first, I'd like to start with Jennifer Watson from Rate. Welcome, Jennifer. Jennifer and I have worked together for many, many years, and she's an incredible expert in the mortgage business. And I'm so thrilled that you're here with us today.
Hi, thank you, Carol. Thank you. Nice to be here.
Good to see you. And Jane Solimini, also from the mortgage business, a member of our strategic partner, Rate. I welcome you. You've been on this program before, James, and has shared some great information. I'm thrilled that you could join us today.
Thanks, Carl. Glad to be back.
Great. And finally, Mike Bulman, our agent with our Hanover office and also Vice President of Strategic Planning here at Jack Conway. Welcome, Mike, for joining us at Conway Conversations, your first time, I think.
Thank you. Yes, it is. I'm very excited.
I'm glad you're here. Unfortunately, Joyce Augustin, who is going to be joining us from the Wareham office, she had some great things to say, fell ill today, so she couldn't join us. Maybe she's listening though, and I know Jennifer will share some of the ideas that she was going to share with everybody. So I want you to imagine a couple scenarios. First of all, I want you to imagine that you're an agent like Mike or Joyce or any of the people that are listening, and you are representing a buyer and they're putting an offer in on a piece of property. And there are many other buyers that are also putting offers in a property. Or maybe you're the buyer themselves and you've been beat out on your dream home several times, which is enormously stressful. And you're looking for ways to have your offer be considered at the top of those 7, 8, 10 offers that are being considered. We're going to talk about that. We're also imagine if you're a customer, maybe you're an investor, you're self-employed, maybe you've been turned down from other lending institutions and looked at in more of a conservative, conventional type of way for financing. And you meet James and Jennifer and some of the Rate people, and they talk to you about the different options available through our strategic partner Rate. They have some real gems that are available that can uncover opportunities that you may not have even thought of. And we've got a few examples to talk to you about. So to jump in to talk about all those things, I'm going to start with James. James, you're going to start us off a little bit. The past few years have been a little topsy-turvy in the market, right? And rising costs, interest rates have gone up, although rates dropped back down again today. So I'd love you to kind of touch on that. What's an example of some creative, out-of-the-box mortgage products that you've seen that have really helped buyers get into a home that maybe otherwise would not have had that chance?
Yeah, absolutely. Well, first of all, thanks for having me back. I really love this program. It gives us all an opportunity to kind of shed some light on some of the things we've been doing. And also, I should say, and this is more for like the real estate agents on the call, the point of this is not for you to be a guideline guru like we try to be in the mortgage world and know all of the details of these products. But the whole point of this really is to touch on the different outside the box types of options so that when you hear those, they're kind of like your brain will trigger. And it's the frequency illusion effect. When you all of a sudden you hear something and now it comes up in conversation, you see it all the time. It's like you like a certain type of car you've never seen before. Now you see it everywhere.
See it
The
all
whole
over.
point is just to understand it enough to be dangerous. And
Mhm.
then from that point to be able to open up conversations with clients or whoever and just generate opportunities for yourself in the market, or if it's a client to generate an opportunity for them to actually close on something. So your point is great. It has been a tough couple of years with rising costs, rising interest rates, inflation, things like that. So a couple of the outside the box things, outside of the self-employed people, which that's a whole, we can run through that in a bit. But for people that are struggling to get offers accepted or struggling to qualify, two most popular that I have. Number one, there are people that don't qualify traditionally with W-2 income, or they maybe don't even have a job, but they have a lot of assets. So we can do asset related qualifications. So it, traditionally speaking, and we're thinking Fannie Mae, Freddie Mac, to use assets to qualify, in most cases, you have to be of retirement age, which is 62 years or older. If we have other programs, portfolio products that we use, you could be 18 years old. If you have X amount of dollars, we can use that over a certain period of time. So traditionally, Fannie Mae, if you are of retirement age, and you don't have to be for this program, would take whatever the allowable assets that we have and divide it by the term. So if it's a 30-year mortgage, we divide it by 360 months. That's the amount of income we can use, which is much smaller. For example, $2 million would be roughly $60,000 a year in income. If we use $2 million for our portfolio product, we're dividing that by 84 months, 7 years. So we'll be able to use that over a much larger income number. That's going to be about $240 or so thousand worth of income in that same $2 million. So these are people that could be recently transitioned from selling a business, or recently sold a home, or transitioning from jobs. We can use assets to qualify as income on a significantly larger basis. So that's number one, which is a fantastic program.
So let me stop you on that. Now, you talked about the people that are listening, whether they're buyers, sellers, agents, they don't need to be a guru on all the details. Now, that was a lot of information that you just provided. And I think the real important thing for everybody to hear there is that if you have visited with a lender and they have asked you for W-2s to show that you're employed, or maybe 1090 is a different story. We'll get into that. W-2s, and you don't have the income to qualify, they should give you a call, because if they have assets, if cash in the bank from some type of large transaction, they might be able to qualify.
Right. It doesn't have to be cash either. It can be 401k. You don't have to liquidate it. We don't have to show proof of liquidating it. For a live example, one that I closed recently, it was a second home transaction. So obviously no rental income, where the borrower had, there were two borrowers. One was W-2. One was recently transitioned 1099. We had a couple things going on there, but we used asset depletion to supplement the income. So we can still use W-2. We can still use everything they have. But now if we have a cash account or retirement account, say there's 500,000 in 401k, I can use a percentage of that divided by 84 months. Now that's income that I can use to help qualify. So these are people that are maybe on the fringe, or they don't qualify for certain reasons. I can use that as a supplement for income. In many cases, especially a lot of portfolio lenders over the years, they'll allow you to do asset depletion or any of these type of funky type of loans, but only one. You can only do one. You can't include anything else. We can mix and match and use all of it to come up with a loan approval, which is fantastic.
Really creative. I like that idea that it could be supplementing income as well. Is there any seasoning requirements on that? So in other words, is that those deposits have to have been in the bank for a period of time?
We typically want to see a 6-month average. So we look at, make sure the funds have been there for 6 months. So typical seasoning is going to be 2 months, but we're going to look at 6 months.
Well, that's not bad. So in other words, if I win the lottery, 6 months from now, I can use that cash to help supplement or help me qualify for a loan.
That is correct. So if it's within the 6 months, the lottery is actually in there as a no-no, but if it's after 6 months, you're fine.
Interesting. All right. That's great. That's really creative. Now, one follow-up question on that for a moment. James, you talked about Fannie Mae and Freddie Mac, and these products are in a different bucket, right? Can you just explain a little bit of the difference between Fannie Mae and Freddie Mac and what that bucket is called and what this bucket of loans are called? Yeah.
So Fannie Mae, Freddie Mac, this is kind of the base set of mortgage conventional guidelines. Fannie Mae, Freddie Mac, the biggest securitizer or purchaser of mortgages in the country. That's where every lender, whether it's a local credit union, mortgage company like Rate, credit unions, whoever, they're going to be underwriting these loans to Fannie Mae, Freddie Mac guidelines to be able to be sold on the secondary market. That's one set. That's your traditional kind of conventional type of mortgage that you would hear of. This other set it's for us, it's a portfolio mortgage. So it's something that we keep on our books. We're securitizing ourselves. So we're playing by, mostly we go by Fannie Freddie guidelines, but this is the outside the box type of stuff. So it's not going to meet Fannie Mae, Freddie Mac guidelines. That's why these products are there. So it's
Okay.
two completely sets of guidelines.
That's huge. That's a game changer.
Yes.
And for those of you who don't know, so Rate, I talked about Rate being our strategic partner. We're separate companies. We have a relationship. We trust the loan officers we work with. And Michael's going to talk a little bit about our relationships with our Rate loan officers. But what's important for people to know that are listening is that Rate is the second largest lender in the entire country. And so as a result of that, Rate is able to provide so many options to our buyers. And by the way, for those of you who are listening that may be working with another real estate company, Rate can work with any person out there, any realtor. We're just very fortunate that we have been chosen and included as a partner for Rate. So I appreciate that. That's great. Before I go to Jen and Mike, James, just to stay on those portfolio products, could you talk to us a little bit about self-employed? Because I think Mike has a really good example of a customer that's assisted.
Yeah, definitely. So self-employed borrowers have traditionally been the toughest because a lot of times they have really good CPAs. They don't want to pay taxes on what they're declaring as income, so they write off as much as they can. But then, according to again Fannie Mae, Freddie Mac normal guidelines, we can only go off the income that you pay taxes on. That's really what it comes down to. So getting creative with self-employed people, again, these are the most common is, let's say you went from a W-2 and you recently transitioned on your own. You're a recently transitioned 1099 employee as opposed to W-2 employee. Traditionally speaking, you're in no man's land for 2 years. You can't do anything until you have 2 years of reported tax return income where you could be making significantly more money than where you were before. We have programs for that. So we can qualify off of basically your current 1099 income, average with your recent income. If you do have a really good CPA and you don't traditionally show enough income, we can qualify off of business bank statements. So we can look at the last 12 or 24 months of business bank statements, look at what the deposits are, use a certain factor there and give an income number to the deposits for your business that's clearly making money and you have to have a certain percentage ownership in the business. We can go off 1 year profit and loss statements. If you can go off an ITIN number, individual tax identification number, where that's someone who is a self-employed borrower but doesn't have a social security number, doesn't have a legal visa. We can qualify off of that as well. So there's a lot of ways to get creative with the self-employed people that are obviously working and being successful.
Okay, that's great. And traditionally that can be really tricky, right? And I think the key here, again, going back to what you said, we want to trigger some ideas. And Mike is now going to talk about why that's important. Just having that little idea in the back of your head. Like James said on Conway Conversations that they have a product that's perfect for self-employed people to purchase a home. Hopefully that will trigger something for someone listening. For the listeners out there, feel free to post any questions that you might have as we go along. We're going to be speaking for about an hour on these topics. We have a lot to cover, but if there's something that you would like us specifically to answer surrounding these topics, just put the question up and I'll be monitoring that. Mike, let's start with your relationship with James. James is a great loan officer, professional. He's been in the business a long time. He's assigned to your office here at Jack Conway, so you created a relationship with him. Can you talk to us a little bit about why that relationship is important and how that's a benefit for you as a realtor in the eyes of your buyers and sellers?
Yeah, no, thank you. And I think for the relationship, James is the only loan officer I use. And in the past, when we've had relationships, I would still kind of dabble, maybe some other loan officers. But James is really my exclusive loan officer because I got pre-approved by James when I was going to buy a house. That's what I always tell my clients is that if I can trust him, you can. And I always tell people when you refer someone where I get a referral, my job is to make you look very good. And James does that every other time. So I worked with a bazillion loan officers, and then this issue comes up, and James is really good, but his back end is incredible too. And it makes it very easy where I can put them in the same hand. We have our own little system worked out. I send them a lead this way, and it gets done this way. And the same thing with title and insurance. I just have the same system, and my clients expect that. So what I found is when I was working with multiple loan officers, I was expecting them to do this. There was a whole different situation every single time. When I really kind of honed in on just James, it made my life a lot easier. And I was able to trust him with my clients a lot easier because I know what you're getting with James.
All right. So what's important to you is someone that you can rely upon and trust. You know, trust is such an important point because this is in most cases the biggest purchase anybody will make in their life, and that lending aspect of it is so key.
And one thing that it does help that he's works with guaranteed rate or rate. I'm sorry, that they have all these products, because I've worked with a lot of loan officers, and James, he can sit here and talk all day for products, how many he has, and it's incredible because, and I'm going to talk a little bit probably in a second of how many clients come to me. I would like to buy a house, but and a lot of these banks are kind of one size fits all. Not all of them, obviously, but it's a lot of where I say, go talk to James, you know what I mean? And he'll kind of come up with sometimes a crazy scenario where this is going to work and that's going to work. And I'll talk about that in a second, a little bit more from your next question, but that helps. It puts a lot more money in my pocket than just saying, well, see you later. Good luck. Call me in 2 years.
That's really important. Yeah, thank you. So tell us, James, you talked about some unique opportunities there. Mike, have you had direct experiences with some of those loan products that you've made clients very, very happy with?
Yeah, absolutely. So I have a lot of clients. I'll say a couple smaller ones and price point wise, and then a big one we had was a real success. But I was telling James asked me this question. One guy went on his own being an electrician, and it was really difficult. Every bank said no to him. And he really wanted to buy a great buyer, had everything he needed, but just did not have that. And James used that year-end P&L or the 1099. I can't remember what James ended up doing, and he was under contract within like 2 weeks of getting pre-approved. So as a realtor, like, James looks like a hero for me, right? And as the broker, because I didn't have that commission in my back pocket unless James made that happen, because every other bank said no to this gentleman. And he's by far qualified. He just didn't have those 2 years that James was talking about. So his name was Michael. Michael was through the moon. And we've had a couple of guys and gals leave their companies and start on their own. And James has done that same thing, rinse and repeat. But the thing is now knowing this, and James is a very good coach to me, where he gives me and I like how he says dangerous, because I get nervous going around saying everything I know about loan originating, because I don't think that's a great idea as realtors, because that's not our field, and that's just how I feel. But James gives me enough and consistently, because everything's changing. Every week they have a new product, so I'm constantly sitting down with James, calling and telling, hey, this is what you need to be telling your clients. And the reason that's important, if you don't have a loan officer that's doing that, is you want your clients to know because that product they're in, they might be paying way too much over 30 years or whatever it may be, and you're getting a lot better deal. And I can probably say a half dozen, closer to a dozen deals that I would not have had unless it was between Rate and James. And then one big one we had, and I won't name names, but me and James were talking about this, is one woman, she was qualified to the max, right? But she just started this company that just took off. And every bank said no to her. And it was James will remind me, it's either, I forget what the company was, but
The therapist.
Yes, therapist company, and her practice just took off. And James had this product. I knew about it because James told me about it in an office meeting, because he tells us all of this stuff. And I was able to bring it to her when she was like, I'll just wait 2 years. And so let's do one more thing. And it was a very high purchase price, and we closed that because of that. But that money, that deal, that person buying that house would not have happened if me as a realtor didn't have James, and I wasn't being coached by James to say what you know, right? Because it's very important that you don't want to sit there and be that agent that says, oh, I don't know, I'll get back to you on everything. You got to know enough about the process, and that only happens if you have a great loan officer teaching you. Like I said, I don't think every realtor should be saying they know everything about banking, because I don't. I know very little, but I know enough to get a conversation, get them to a warm lead, and get them over to James and get them pre-approved.
That's so key, isn't it? And it's a team, right? And we're gonna go to Jen. Thank you so much for being so patient. I've worked with Jen for a long, long time, and I do know that her offices, and for those of you who are not part, we just lost Mike, not part of Jack Conway, our loan officers are dedicated to certain offices. So they develop relationships. And here at Jack Conway, relationships are really important because that's how we succeed together. Because we feel very strongly that you succeed together, and that success in the case of real estate is successfully putting a buyer into the home of their dreams. And there's nothing better than that, right? So Jen, I know you've had that opportunity to do that with many, many clients through Jack Conway. And I want to talk first about your relationship that you have with our agents and why that's important and how you've developed that to the point, just like Mike and James talked about. Why is that connection so important?
Well, first off, thank you, Carol. Thank you for having me. It's my first, and I'm excited to be here. But the relationship's very important because you build that relationship, and I've been working on it and building my relationships with my offices for years now, and I've enjoyed every minute of it. And I have some great relationships. And I'm sorry Joyce couldn't be here because we have some great stories to tell, and I'll fill you in on some of them later. But we have a great relationship, and it's very important to build that relationship and teach, like Mike and James said. I mean, Mike learns a lot from James, and I'm sure James learns a lot from Mike as well. But teaching the relationship and learning just enough. You don't want to overlearn. And I mean, I don't know Joyce's job, so Joyce doesn't know mine either. So it's learning just enough.
So it's having a great teammate. Yeah,
Yes,
I love that.
absolutely.
You know, I always feel like the best thing you can do is surround yourselves with people in this world that know more than you.
Yeah.
And have the humility to be able to do that, because
Mm-hmm.
that's really important, because we can't bring everything to the table, and we certainly can't do that for our buyers and sellers. So I love that. So Jennifer, we're going to talk about something called Power Bid. And Power Bid is, James talked about product types, and we're going to get back into a few more product types. What Jennifer's going to talk about is more about a process. And Power Bid to me is, to use the word, a really powerful tool to help a buyer put themselves in the absolute best light when it comes to the seller. So we're talking about pre-purchase and sale agreement. This is the buyer super excited about buying a house, and they're about to put an offer together with, in your case, Jen would say Joyce, and she's going to make an offer on the property. You want that buyer to be the one that the seller says, yes, I want them. So tell us what Power Bid is.
So every buyer you want to be pre-approved before you go in to make an offer. So the difference between a pre-approval and a power bid approval is the pre-approval is just that. A loan officer takes the information and gives the buyer a pre-approval. So the buyer is pre-approved for that purchase price of $600,000. The difference on a power bid approval is we've taken, as a loan officer, we've taken that information from the buyer, but we've taken it an extra step. We've gathered all of the documentation and we've given it to an underwriter, and the underwriter has reviewed all the credit documents, the credit report, everything, and issued an actual commitment, and has given a credit approval, not just a pre-approval, for that buyer to walk in with a credit approval, a power bid approval that shows that their credit worthiness. And now they have an approval in their hands, subject to only the appraisal, the title, the homeowner's insurance, and if they have a house to sell, subject to the sale of their home. So they have that actual strong approval.
Let me stop you on that just to go back a little bit. So Jennifer, if I were to apply for a loan for you and I was looking for a pre-approval, just a traditional pre-approval, I would give you my W-2s. I would give you my bank statements. You would ask me some questions, and you, as the loan officer, based on your expertise, can deliver an approval subject to an underwriter. The underwriter is a totally different person than Jennifer. They're in another building. They're probably in another state, but they're the ones that are going to look at all this information and say, okay, I agree with this. They're going to give you an actual approval. So the pre-approval, you're giving it to me, right?
Correct.
Okay. And you're an expert. You've been doing this a long time, which is amazing, but you're not the final say, are you?
Correct. No, I'm not.
Who's
I'm
the
not, I'm
final
a loan officer, and your pre-approval is subject to, the conditions are subject to the underwriter review.
Okay, so the underwriter's kind of like God, like
The underwriter is God.
I'll say they will. So they are the one that is going to really make the decision whether everything that Jen or James collected is all A-okay, right? Okay. So in the case of a power bid, you're packing up all my W-2s, you're looking at my bank statements, you look at them, but then you're submitting them over to this underwriter and they look at them.
Yes.
All right. That's really cool. How long does that take?
For the underwriter to review, typically maybe 48 hours.
Oh, wow, that's quick. All right,
It's
that's
very
great.
quick.
Because there's a whole
It's
bunch of
very
other people that are trying to get a power bid as well.
Mhm.
Yeah, this is a popular way to go for clients with great.
Absolutely, absolutely. I offer it to most of my clients. Most of my clients can get it unless they're looking for a bond program or some special program that I cannot do a power bid on.
All right, so there's certain programs. So in
Yes.
other words, if I qualify for power bid, you're going to
Mhm.
say to me, Carol, you got to go power bid.
Absolutely,
All right,
absolutely.
great. I love that. All right, so you've taken my information, you've submitted to the underwriter, I get my power bid approval, and now I find the home of my dreams. And
Yes.
there's 8 other people that are making an offer on the same home. Why does it matter that I have a power bid?
Because of several reasons. First off, you can compete more with cash offers because you are a stronger buyer. You already have that approval that has gone through underwriting. You already have a strength buyer that you can close in as little as 2 weeks. If we even need an appraisal on the property, we might not even need an appraisal to get to the next step, and we can close quickly. So that gives you more of a leverage against other people that have not gone that extra step and gone through the underwriting process and have an actual credit approved approval and only have that pre-approval.
So if I'm dealing with a seller that is in a hurry,
Mhm.
and they see my offer and I can close faster,
Mhm.
that power
Yeah.
bid give me that.
Yes, gives you
Like,
that leverage.
okay, all right. You had mentioned a power bid is subject to appraisal, homeowners insurance. If I'm selling a home, it's going to be, and I put that as a contingency, it's subject to that, right?
And
But
clear
if I'm a
title.
cash buyer, it's the same thing, right?
And clear title. If you're a cash buyer, yes, and clear title.
So it puts me right on the same level, pretty much,
Same.
as a cash buyer.
Same level.
That's huge. I think that is really exciting. And can you, I know Joyce had some really great examples of when
I
this is
did.
for the customers. Can you share some of those with
I
everybody?
sure can. Joyce referred me a client. His name was Michael as well. We talked to all of them have been Michael today.
Yeah.
His name was Michael, and he was getting very depressed because he had a regular pre-approval, and all of his offers, he was making several offers, and they were all getting beat out by all these other offers. So we decided to do a pre-approval, power bid pre-approval, and he was so excited because he just got so excited because he had a better understanding and a better grip on what he could offer, and what, he just felt so much stronger. So now he's out there and he's ready to make offers, and he's just so thrilled that he can compete better. He just has a better look on everything. He was just so depressed, and now he's thrilled to go out there and make offers again.
So he's out looking for a home right
He
now.
sure is. He sure is.
That's so exciting. And so you said something important there. This gave this Michael, we have a
Yeah.
lot of Michaels around
This
here.
Michael.
This Michael, confidence that he didn't have before.
No, he was so depressed, and now he's just
Oh my gosh.
he's got so much more confidence.
Wow. So the other Michael's therapist
Yeah.
client running out of clients without, since, with power bid, they're going to make everybody happy.
Yes, yes.
That's really great. Was there were a couple examples that Joyce had had?
She had another one. Their names were Kim and Jim, and they had subject to the sale of their condo, and they came and did a power bid because they lost out on that one. So now we did a power bid for them, so they will not lose out on the next one. So they're very excited about that as well.
All right. That's really important. Mike, Jennifer talked a lot about people losing out, buyers losing out on properties. Let's talk a little bit about the current market. You and I actually had a conversation about this about an hour ago. What are you seeing out there for the buyers that are listening? What type of advice do you have for them? Any thoughts on that?
Yeah, so this is to be frank, it's one of the hardest climates I've had to get an accepted offer, and I've been in the business for about 9 years. In my opinion, I know some people don't believe that, say COVID, this, that, and that, whatever, but I find this right now, this climate to be very difficult. Rates have been doing really well. James will probably talk on that, and inventory's up 13% year over year. So I'm praying to the real estate gods that continues and we start seeing that in our area, because we really haven't. But it's one thing I have noticed, and I did this back when it was super crazy before too, is a lot of my clients now, and we kind of talk strategy, is what you'll find is when there's some properties on the market, very few in the areas we're in, and you'll see the ones that say 80, or so, we'll start even higher. When people see 30 days on the market, they're like, that house, something wrong with that house. See you later. 30 days on the market. And then on and upwards. For example, I had a woman reach out to me yesterday. It was 180 days on the market. She said, no, not interested. You know what I mean? So I drove by
They're
her.
really aware of that. They're paying attention.
Yeah, but the problem being is what I talk to my clients, maybe start looking at some of those, because
Yeah.
90% of the time, maybe not so much 90, it's the price, right? And that seller, we don't know what that seller's, because the reason I'm bringing this up is twice last month, my people there filled out a bazillion offers and got rejected, and they did that. They picked out a house that's been on for, I think it was 50 days. And before, they're like, oh, what's wrong with that house? Like every first time home buyer, and then just looked at it and it was the price, and we negotiated the price down. So that's some strategy we've been doing, is just kind of looking at those. But to touch on the power bid thing that Jen was talking about, even looking at it from a seller's standpoint, if I'm getting an offer, because any agent that's listening to this knows where I'm coming from, and I'm getting one from whatever, I'm not going to name companies, some random loan officer companies that are maybe online or whatever it may be, those offers don't look as strong to me. But when I'm getting one from a guaranteed rate, that looks really strong, because they're guaranteed rate, I'm sorry. And then it has the power bid on it. Now it's my job to inform the sellers and coach the sellers that, hey, these guys are only a couple weeks away from closing. They've done that, where their commitment is usually a month out from accept offer. They're already there. I'm sorry if you can get us, my computer. So,
The buyer wants to offer that.
yeah, something like that. I don't know how to turn it off. But so buyer climate for the power bid is huge. I think even on the sell side, if I saw that as a seller's agent, that stands out, A, because it's an incredible company, and B, it's an incredible product. And the one thing I think Jen touched on a little bit is I've introduced it to a couple buyers and who are a little hesitant. It doesn't take all that long. You would think, even when I first heard about it, it would take a ton of time, because you think about how long it takes to get to the commitment date in an offer. So a lot of people see that and they're like, oh, no way, I don't have the time. I'll just do the pre-approval, where I just have to log in, whatever it may be. So it does stand out. And then what your agent should be, or you as the agent, needs to tell the seller's agent how important that power bid is. You can't just submit your offer and say, hey, it's power bid. Some agents don't know what rate is, don't know what power bid is. And what I do with my offers is, when I put an offer in, I CC James on every offer. And James then calls the seller's agent, because kind of go back to what I'm saying, I'll tell them how I feel, but James is the expert. James is my guy. He's going to do the extra leg. And I've seen James push to get some accepted offers. And we've got creative with the listing agent. And he really will go to bat for my clients. So it's back to being, not even saying back to, but I think it's that power bid is just another tool I have right now in what's a very, very competitive market for me.
That's
And
yeah, go ahead, Jen.
Mike, to touch on that, the power bid approval letter actually does state that it is credit approved, and it is completely fully underwritten review of the credit worthiness and secured loan credit approval. It states right on it. So to highlight that, for an agent to highlight that when they're submitting the offer is huge as well. So to know that pre-approval states right on it, rather than stating that it's just a pre-approval, is huge as well, because it does state right on it that it's been fully underwritten. So it's huge to show that as well.
That's a great point. And even if you replace, for those who are listening, the word fully underwritten to fully verified, because that's the key. I mean, that underwriter is the one. They're the gatekeeper. They're the ones that are going to make the decision. So Mike, you had talked about the market itself, and I want to comment a little bit on that, because I talked to many Conway agents and managers about the market, watch the stats very carefully, obviously. And so what we're seeing this year, we have a small data point right now, it's not a lot of time right now, but the number of properties that have come on the market are up double digits. Okay. So that sounds like good news, right, everybody? So what is our biggest problem right now? We don't have enough inventory. Our inventory is properties to sell. So stated more simply, there are way more buyers than there are properties available. Okay. So we know that we've been dealing with that. Any buyer or seller that's on the call understands that. So this year, what we're hoping is that would open up a little bit, right? So first step is, yes, there's more properties that have come on the market. That's good. But interesting enough, our inventory is down slightly. It's only down by a 1 or 2%. But what that means is that all the buyers that Mike is talking about have, made offers on those properties. We got a lot of buyers out there, and that they're qualified. They're able to buy a house. And so as a result, we're back to that situation where there is not enough houses for people available. So we're kind of in the early parts of the market. This is March 4th. We're right at the precipice of the spring market. So, what happens in the spring market? People start to come out, they put their houses in the market, and people are coming out to look for houses. So Mike, I'm going to come back to you on this for a moment. I think what we're reading and what we're hearing is many people in the baby boomer generation, and of course I'm in the baby boomer generation, as you know, I'm at the very tail end of it. And there's a lot of people in my age group that are still sitting in houses with lower interest rates, possibly, large houses, and they haven't selling them. So the old rule of people sell their house every 7 years, that's kind of out the window now, right? Like, what's happening out there?
Yeah, and it's you said it as those rates. When I sold all my clients, what it was 5 years ago now, some of their interest rates were in the middle too. So when I call them to ask how they're doing, this, that, and the other thing, they always kid. They're like, "I'm never leaving Mike with this."
You're happy.
But that being said, and before that, about 6 or so months ago, I would get I'd call, do my cold calling, whatever it may be, and say, "Hey, looking to make a move, whatever it may be," and they say, "We are not leaving until interest rates get to X, Y, Z." I personally don't think, and a lot of people have been here, from what I'm reading through really smarter people than myself, you'll see the twos, definitely not twos or threes, and some people don't think you'll see low 4% ever again. So, and I might be very wrong on that, but that's just from what I read. That being said, I'm starting to see a lot more buyers enter the market. Like James might speak on it. James and I might have close to 10 people pre-approved right now that are just sitting there, not waiting, actively working. So I think, and that's a change, because the end of last year, it was a lot of people sitting there waiting. So I'll wait for the interest rates to come down. I'll wait for the interest rates to come down. I'll wait for the interest rates to come down. But now I think they're sitting on the sidelines so long that, in my opinion, the rates are here to stay. And that's what I'm telling my people. So I see a lot of other realtors saying you're going to see rates in the 5s this year. And I again, what I've heard and people smarter than me, I don't think that's going to happen. So what I'm telling Mike, and I think that's what it goes back to, you coaching your clients. I've used the word coaching a lot today. Is if I'm telling my clients that I don't know if that's great information. I don't know all that much either, right? So no one really knows. But I think a lot of my people are getting used to this being the new normal. That problem being is now all these folks and I've had more leads in the month of February than I think I've had in my career in February and January. But now we have a ton of these leads of people just not selling their houses. So I do think that was January, February. I do think, like, with the market came up a little bit inventory wise. Like I said, it was 13% in February, which is great. And I do think you'll see more coming March, April, May, those 3 months. But it will be also very interesting, because I have a lot of clients saying I'll start looking in April, in May and March, whatever it may be. So what I'm trying to say, I think your buyers are getting less nervous about the rates now. I think it's just getting those sellers out of those 3, 4, 2.5 interest rates is really what I'm finding the trouble.
So basically what you're saying, and this is a really interesting thing to think about, is the buyers are realizing that we're not seeing 2 or 3% rates anytime too soon. And all the prognosticators that I follow and we read, Mortgage Bankers Association, Fannie Mae, Freddie Mac, FHA, and most people are saying somewhere around the low 6s to mid 6s for this year. And I'm going to come to James in a minute. We're going to talk about rates. So at some point you got to buy, and at some point you got to sell. So that's the key is, if you're a buyer, don't get frustrated. I really feel that we've got some huge pent up demand, and that we are going to start seeing some additional properties coming on the market that we hadn't seen before. So I think that's really exciting. Let's see. I would like to talk about interest rates for a moment, and then I'm going to go to a question. So, James, we did have a drop in rates today. Can you talk about what's going on with the bond market and rates? This is a lot of movement, a lot going on out there right now.
Yeah, I mean, the good news is we're seeing the average 30-year fix today is 6.74%, but we're seeing a lot of rates in the mid to low sixes for the first-time buyers, and many different situations. So the bond market's been doing really well. And just to compare it, you have the bond market, think of the stock market. Mortgages are bonds that are bought and sold. They're investments that they have to make money on, ultimately the investors. So what goes into that, and when you think about overall economic uncertainty, which is what's been happening, that's why people kind of tend towards, or the investors tend to go towards the bond market, which would make interest rates get better. The past couple of years, we've been very, very hyper focused on inflation and jobs reports. And this past Friday, the PCE report, which is the personal consumption expenditure report, that's the report that the Federal Reserve really hangs their hat on and uses to make many of the decisions, and it comes out once a month, basically. So that came back right on the expectation. So if it came back higher, came back lower, that would impact it in one way or the other. It came back right at expectations. And overall, there really haven't been any huge kind of whammy moments with any of these reports. If anything, the jobs reports they've been revising them, and jobs reports have been hurting the bond market because they've been stronger. Overall, the jobs market has been stronger, but the reports, there haven't been any big things that have happened. It's just been overall kind of a slow slide over the last 6 weeks or so with overall economic uncertainty. And a lot of it has to do with new fiscal policies, new administration policies, things that have been coming in that has created uncertainty. So that uncertainty, what's the most certain thing you can do in terms of an investment? Buy a bond. Right, bond is going to get you that rate of return no matter what. So that's why we're seeing a lot of money come back into the mortgage-backed securities. Rates are starting to get better. Granted, we were at, looking recent past, back in September, we had the average 30-year fixed at about 6%. Then we got up to over 7.25, and now we're right around 6.75. So that 50 basis points has been a really, really good mover for us, and seeing a lot of things open up. So hopefully more things to come on the good side.
Good. I think that's great. Yeah. So the bottom line there is when people are feeling uncertain, they go to a place of safety, and bonds are safe, and 30-year fixed rate mortgages follow the 10-year bonds. And, so we're seeing a little bit of that movement. So that means opportunity, right? For buyers and sellers. Great. We have a really awesome question here. So this is going to be for either Jennifer or James. This person sounds like they've been here before, because they thanked us. They said they always learn something when they come on Call Me Conversations. That's good to know. Thank you. And the question is there a mortgage product for people who want to blend an existing low rate, so that customer Michael is talking about that's sitting on a 2% rate, with a new mortgage at a higher rate to get into a new home or pull equity out to make a purchase with a blended mortgage rate? Really good question. So there's some creative ideas. Jennifer, do you want to take that? James, do you want to take that?
I'm happy to if you don't want to, Jen.
Go for it.
Well, I guess the short answer is you can't take a mortgage from a current property and put it on a new one. That's just, unfortunately, it doesn't work that way. In the UK, they can do that. They call it porting a mortgage, where you take your mortgage. I'm taking my mortgage somewhere else. You can't do that.
Oh, that's funny.
Yeah.
So what we can do is we can leverage your current existing equity to put down on a new property. And a lot of times you'll hear that as a bridge loan, where I have a small mortgage on my existing house. I want to take my equity and go buy a new house without selling it. That's kind of where we see bridge loans. That's really a good opportunity for people that if you don't want to have to sell first. And it goes back to what Mike was talking about, making offers that were it's hard to get offers accepted. It's even harder to get an offer accepted if you have to sell something first. So if you want to try to maybe get your house sold with a long closing date, and then make your offer contingent, but you still have to sell your house. So one program that we've been doing a lot of, and this is a way to transfer essentially one equity to the next. We can do a home equity line where we close that home equity lines in as little as 7 days, whether it's with us or whoever it is. We have a program called Departing Residence Program. Departing Residence Program allows you to purchase, as long as you have the down payment, purchase a new property, as long as you have the intent of selling your old property after closing with just writing a letter or sending an email, basically, that we can have you sign, we can exclude all of the liabilities on your old property. So now you can essentially, it's a pseudo bridge loan. So we can do a home equity line on the old property. Once that closes, you can say, tell us, that's we're going to sell this property eventually in the next couple of months after we buy a new house. Now I can use that home equity line as assets to use as your equity in the new property. And I don't have to count the payment against you. I don't have to count the mortgage against you or the taxes and insurance on your old property. So that's kind of our pseudo bridge loan. Bridge loans are like a really popular topic where they're great in theory. They never work in practice because they're just too hard to make it fit a very small box. So this is how we've been kind of getting around that using I call it a pseudo bridge loan. Pull the equity from one, have that in hands with a home equity line or even a cash out refinance, and use that on the new property without having to qualify carrying both mortgage payments. So it's kind of a best of both worlds. But you can't take your old rate with you. You're going to get a new rate on the new property.
I like that. You're courting your mortgage. I never heard that. That's really cool. Okay, so I think what's important there too is that's a pretty complicated scenario that James just talked about. And so, Mike, I'm going to go back to you for a minute. Listening to what James says, what do you think of when you think about, I'm a trusted advisor to my buyers? What does that trigger for you?
So when someone says I'm a trusted advisor, I was talking on a panel, and this is the biggest purchase of this person's life, and I take that very seriously. And I align myself with title, with loan and insurance that are like that. And when I take someone, like a lot of people, they're not all great, James, right? I'll send them over to him, and James will say, hey, it's a no-go. Or the beauty of that is I've also worked with loan officers that I'll send them a person, they'll say there's no go, and I'll send them someone else, and they're pre-approved with someone else. I'm like, okay, what happened here? Where was the disconnect, right? Because I just put my word out, name on the line for James, and now whatever. So the beauty of James is he'll sit down with Sarah and Joe, and they'll say, okay, you're not where you need to be, but if we go through A, B, C, D, C, then you'll be where you want to be. He kind of coaches. For me, it's also a really good retention thing because they're helping work with James to get to that pre-approval spot, so they're staying with him. So for me, that's no bad lead, right? So, and another thing about having James on all my files is James, not only am I reaching out to these people that might not be reaching out or not as motivated, James is too. So like when I say that we're all kind of, he's like, hey, I just reached out to this person, or maybe I don't want to call him a million times. James is also doing that for me on my behalf, so it's not as pushy. But when I work with James, he's my buddy. We hang out here, we do that. He does my loan and stuff like that, and I trust James. And if you can trust me, you can trust James, and that's the way I see it.
That's a really great point. Again, working as a team. Jen, I'm gonna give you a little bit of a surprise question. So Mike had talked about that relationship when a person might not be ready. And I think a lot of times they're not ready because maybe their credit score is a little low. Do you have something in your toolbox at rate that you can counsel, Mike used the word coach somebody so that they can get ready maybe to buy a house in 6 months?
Absolutely. Absolutely. We have a tool that we can use that we can look at their credit score and say, in fact, I'm working with someone now and say, well, if you do this, we can immediately rescore you and find out what you need to do, how much money you'll need to do it, and how to get your score immediately up to this point, or if you work on it for 30 days to get it up to this point. But we can also tell them how much money they'll need to do it. So if they have the money, they can do it immediately, or it might take them a little longer to do it. But yes, we do have those tools.
And how long does it take effect on their credit score?
We can do it immediately if they have the funds and they do it right away, and they give us the documentation to show that they did it, whether it's pay off a debt or pay down a debt or pay down 2 credit cards or whatnot, and we get the documents immediately. We can then submit it to where we need to submit it to rescore them immediately.
And so give us an example that someone, what's a score that's not so great and you're trying to get it to the better score?
So in the case that I have now, it's actually a refinance, and they want to refinance from an FHA loan to a conventional loan and remove the parents from the loan. And their credit score is at 583. So I need to get it up to over 620 to get into a conventional loan. So he needs about $10,000 to do something to get his credit score up. So
do you think it'll work?
Yeah, I can get it there. I can get it there, but he needs the money.
Jen, what if he doesn't have the money? Can he get a gift from a relative?
He can. Yep. Yep.
Okay.
That's
So
and that's the plan. Mom and
Yes,
dad
I
want
got
off.
that
So.
mortgage. I'm gonna get off this mortgage so
Yep.
bad that I'll give it
Yep.
okay, yeah, because that's affecting them as well, right?
Mhm. Yes.
Um,
Yes.
Okay, that's a really important thing. Does that cost your customers any money to do?
It will get once we do it with the credit report, it will cost them some money to do.
I mean, is there a fee to have that process done?
No, not
So-
until we'll charge the credit report. It's a
Okay.
trade, it's a per trade line.
Per trade layer. Okay. All right. So in other words, if this is something if anyone's listening, they've been turned down for a loan and they got a 580 credit score or whatever the case may be, but they've been told that it's credit, is the reason why they need to call you
Mhm.
and you can put him through this process.
We could look at it and put them through the process and we'll get it done for them and then we'll rescore them and then it'll be charged at closing when we charge for the credit report or at application. Yeah.
So I was a loan officer 1,000 years ago and we didn't have that back then. And
We
that's
We didn't.
no. And so that any of you buyers and sellers out there or agents who are new in the business, this is huge, you know? So what we've been talking about over the last 50 minutes is ideas that maybe you weren't aware of, things that are going to help either you as a buyer or seller purchase a home or sell a home, or ideas for an agent to help someone get into a home. And these, first of all, you guys are just the ideas that are coming out of you are just fabulous. James, I want to talk a little bit more about those portfolio products, those unique products. What if I'm an investor? Is there anything for investors?
Yeah, so investors have there are a lot of products that have come out that have made it easier for investors. And now, again, we're always comparing the Fannie Mae, Freddie Mac traditional mortgage products to these other products. So in terms of, I could talk about products all day, as you can tell, I can talk about products all day long. But we have a lot of residential commercial stuff that has just come out. But the most popular for, I guess, on the residential side, for people who are trying to pick up, let's say that you have an investor that buys multifamilies or even buys single families or whatever it may be to rent them out. We have a product that is called a debt service coverage ratio loan, DSCR. That it's been around for a while, but this the key points to this is with traditionally Fannie Mae, Freddie Mac, you can only have sometimes up to 5 properties, up to 10 properties. We can have up to 20 properties for this particular program. That's number one. Number two, it's very much like a commercial loan, where a commercial loan will look at the property more so than the borrower themselves, where we're looking at how does the property perform. So debt service coverage ratio, DSCR is the acronym, looks at the property itself and if the rent will cover the liability on the property. And this could be whether it's a long-term rental, say you're buying a 3-family and you have, whether it's market rent or it's already completely rented, we can use whatever the gross number is. Let's say it's $8,000 in rent you get per month. As long as that covers the mortgage 1-for-1, it's a 1.00 ratio, we can do it. The only thing we look at for the borrower is where's the cash coming from and what's your credit score. That's it. We're not looking at tax returns. We're not looking at other properties. So when you have people that have a lot of properties or businesses or whatever it is, traditionally speaking, we're underwriting everything. We're calculating all of the income numbers from the self-employment or the rental income. And it's a lot more paperwork. It's a lot more involved. And a lot of times it doesn't work. With this, we can just look at the one particular property. We're drowning everything else out. Does this property work? Do you have the credit score and do you have the cash? And as long as it goes 1-for-1, that's great. A lot of lenders are 1.25 or 1.5% for that ratio, where it has to be at least 1.25% of whatever the liability is. We can go 1-for-1, which is fantastic. Now, another vein, I guess, is let's say that it were someone buying a really nice single family on the beach somewhere to rent it out with Airbnb. That's popular. Long-term rentals, as many people know, long-term rentals have less monthly income than what you could potentially get on nightly rates or Airbnb type things. So we can actually use now, even for first-time investors, if they were going to buy, say, an Airbnb property on the beach down the Cape, or we're in Florida, wherever, you can use airdna.com or any of these other types of market, I guess, estimates for your daily rentals. So you're going to have your peak seasons, you're going to have your low seasons, whatever that average number is. Now that's our monthly number. So let's say you get a single family you could rent for $3,000, but because of Airbnb, your average is going to be $8,000. You can finance a lot more because of that monthly average, which is fantastic.
That is huge. Okay, so quick question on that as a follow-up. Question from the audience. What is the program that you're talking about? What is that called, James?
It's called DSCR, debt service coverage ratio.
DSCR. Hopefully the
Yep.
person that asked the question got that. So those initials, call James. If you don't, and actually, Alyssa, I think you're out there producing for us. Maybe you can put James's phone number out there in the chat, but we will follow up with James's and Jennifer and Michael's phone number for anybody they're looking at after the call. Okay, another question just came in for either James or Jennifer. I am planning to purchase a family home from my parents and have heard of a gift of equity letter helping me qualify for a mortgage. Can you tell me if and how this works to help with a purchase?
You want it, Jen?
Go ahead.
You want so, all right. So you can certainly use gift of equity. Gift of equity is looked at just the same way as a gift of cash. But you can say whatever as long as the property appraises for it. Let's say that it's a family kind of property that they say, you give me 500,000, I'm good. That's all I need. But the property's worth $1 million. You can structure that purchase and sale agreement however you'd like, and they can give you any amount of gift of equity that they want. So that's treated just like cash. So a lot of times when we do a family sale, we'll structure it. It's all done on purchase and sale agreement. We'll say purchase price is $750. We're going to do a $250,000 gift of equity. So that means that now your mortgage is $500,000 and you have all that equity. That means that you had, in that example, what's that, 20-30% down payment, you're not paying mortgage insurance. You can also, in that scenario, you can add a seller credit to pay for closing costs. So you, as the person that's essentially, you're buying the property, but it's kind of inheriting it, you could get a new mortgage and get that property in your name with $0 out of pocket, all by structuring it on the purchase and sale agreement. So gift of equity is now it has to be from an acceptable donor. It has to be family. It has to be someone that's an acceptable gift donor, which is usually family, or it could be a spouse, ex-spouse, that type of thing. But it can't be a friend. It has to be an acceptable donor.
Boy, that's great. I have to compliment both the person that asked the question and you, James, because that was an example of exactly what we've been talking about here. Is if you have an idea and you're not sure, ask the question. Ask it to a person that you know can answer the question. And if that person doesn't know, they're going to introduce you to a team member that can. So with the last 3 minutes that we have, this has been such a great conversation. Jennifer, leave us with a little piece of information that you don't want anyone to forget who's listening today.
So as far as power bid goes, just keep in mind that it's peace of mind, knowing that the financing is set, that it's in place. There's no worries that at the last minute, you're going to hear from your loan officer, oh, the underwriter needs this.
Oh, that dreaded
Remember
call.
that?
Yes.
You're not going to hear that. It's a peace of mind, knowing that it's all set.
I love that. Mortgage financing equaling peace of mind.
Yes.
That's a good concept. Great. Jennifer, you've been fabulous. Thank you so much for everything that you shared today.
Thank you.
James, how about you? Leave us with some pearl of wisdom.
Pearl of wisdom. So I would say if you take anything away from this, it's number one, try to know enough to be dangerous, like Mike was saying, but don't try to recreate the wheel. Think about the conversations that you're having. Things like this can pop up. Hopefully we created new trigger words in your brain where when you're talking to somebody, you can say, well, you might have a solution here, or you might be able to go beyond the first no that you got, and hopefully it'll create more opportunities. In this limited inventory market, creating opportunities is the name of the game.
How fun is that to be able to create an opportunity that might not have existed otherwise because you listened, you showed up today. You all listened. You listened to Jen and James and Mike, and you have a trigger word that you didn't have before. I think that's so cool. So thank you very much, James, for teaching us trigger word, because I'm gonna keep that with me. So, and as always, I really appreciate you joining today. Thank you.
Thanks, Carol.
And Mike, well, I'm going to ask you to close this out. We have 2 minutes. Tell us, what you want everybody to think about as we talk about all of these different opportunities.
Yeah, and mine's going to be speaking more to the agents on the call. So in mine was also similar to James's, where I coach a lot of agents at the company now, and a lot of new agents will come in or outside companies like, "What's your advice?" And everyone's like wants that silver bullet kind of thing. And there's plenty of advice you can give, but mine is just know your stuff. Like James said, whenever if you're a brand new, you're a seasoned agent. These are the things you should know, because when someone asks you, you're at the dinner and you say, "How is the market?" and you say, "It depends on what you're looking for," but you don't know what to say after that, they're probably not going to work with you. They're going to work with the people that know their stuff. And those people that say, "Oh, but I'm brand new." When I was brand new, I knew quite a bit more than a lot of veteran agents because I studied my tail off, and I sat down with people like James. I sat down with Jennifer. I'm sorry, sat down with top producers, attorneys, and asked a lot of questions. Just because I wanted to be in the room when someone has a question, I could sound like the expert because I didn't want to be, okay, like I said earlier, "Oh, let me get back to you. Let me get back to you. Let me get back to you." That's okay to say once or twice in that conversation, but if you say it constantly, people are going to lose confidence in you. So just know your stuff or study your stuff.
Gosh, that is great. You know, I think about the concept of knowledge is power, right? And you know, we all talked about you don't have to be an expert. Have a little bit of information so that you can be that person that people are going to continue coming back to you, whether you're a lender, an agent, or any other person in a different field. You know enough to be able to guide people. And then have all your people lined up that can be the experts that can answer those questions. I so appreciate all this, these ideas. You know, to me, I am certain that every single person that listened today went away with something they didn't know before. And if we've done that, then we've succeeded here at Conway Conversations. I appreciate the three of you joining, Jennifer, James, Mike. Great guest today. Excellent topic. We could probably talk for hours on this. I want to thank all the people that tuned in today to listen to us. If you have any other follow-up questions, Alyssa has provided you with contact information, and you can always reach out to me as well at cbulman@jackconway.com, and I will introduce you to one of them. Thank you so much for joining us, and good luck out there. Have a great day.
Thanks,
Bye-bye.
Carol. Bye-bye.